Welcome to the Opening Bell Report.
Friday the 13th. Usually when that date comes up, people get a little
A
weird.
little superstitious, yeah.
Totally. Looking over their shoulders, avoiding black cats, that whole thing. It's horror movie central.
Well, it definitely has a reputation.
But if you were an investor tracking the robotics sector this past week, specifically a company called Knightscope, ticker KSCP, Friday, February 13th, 2026, was anything but a horror movie. It was more like an action thriller with a really good ending.
Well, unless you were betting against them. If you were a short seller, it was absolutely a horror movie.
That is a very, very fair point. But for the bulls, for the people just watching the charts, we were talking about a massive intraday surge.
Yeah.
Double digits. The kind of move that makes you, stop scrolling, spill your coffee, and ask, wait, what just happened?
And more importantly, is it going to happen again on Monday?
That is the million-dollar question. Or, given the size of this company, maybe the $46 million question.
Something like that, yeah.
Exactly. So today, we're doing a deep dive into a specific analysis report called the Knightscope Momentum Report.
Right.
And the subtitle, it really says it all. Don't miss this move. We have this report in front of us, and we are going to strip it down to the studs.
We're going to look under the hood?
Yeah. We're not just looking at the big green candle on the chart. We're getting into the engine room. Why did it move? What were the mechanics?
And what does the report forecast for the week of February 16th? Because it lays out some very specific scenarios.
It does.
And just to set the ground rules here for everyone listening, our mission is strictly analysis.
Yes.
We have this one report, and we're dissecting it. We're looking at the data, the catalysts, the scenarios that are mapped out. We are not financial advisors.
Not at all.
We aren't telling you to buy or sell. We're just the narrators of the numbers.
Narrators of the numbers. I like that. And honestly, these numbers tell a pretty wild story. The report calls Friday's action the move.
Capital T, capital M.
Right. Because Knightscope didn't just, tick up a percentage point or two.
Oh, no. According to the data right here in the report, Knightscope saw a 13.52% surge intraday.
13.5%. That is a serious move for one trading session.
It is. But what's really fascinating to me, and what this report emphasizes, isn't just the final number. It's the shape of the day.
Okay.
You have to look at how that candle was formed to really get the psychology behind it.
So walk us through it. How did the day start?
So it opened at its lows, right around $3.58.
So it started the day kind of sleepy.
Exactly. There wasn't some massive gap up at the opening bell where everyone just rushed in.
Which is what you usually see with big news, right? The stock pops at 9:30 a.m. and then it just sort of fades.
That's the pop and drop. This was the opposite. This was an open, low, close high day. It finished near the highs at $4.03.
That tells a very different story about market psychology.
A very specific one. The report calls this smart money accumulation.
What does that mean exactly?
Well, think about it. If the price is grinding higher all day, it means investors weren't just waiting for a dip. They were chasing the price up.
They were hitting the ask?
They were hitting the ask. They were buying at $3.60, then at $3.80, then at $4.
They were buying the rip, not just the dip.
Precisely. And that sustained demand suggests real conviction. It suggests whoever was buying wasn't just trying to scalp a few pennies. They were building a position.
And there was a technical reason this was so important, right? A barrier it broke.
A huge one. The resistance levels. The report puts a massive emphasis on the 380 to 390 range.
The ceiling.
It's been the ceiling for a while. Every time the stock got there, sellers just stepped in and pushed it back down.
It's like that boss level in a video game you just can't get past.
Until Friday. Friday was the battering ram. Closing at 403 completely changes the character of the chart.
So the sellers who were camped out there are just gone.
They're gone. Either they sold out or they were just overrun by the buyers.
Okay, so that's the what? A 13% surge, breaking key resistance. But this is a deep dive, so we need the why. Why Friday the 13th?
Well, the report points to three main catalysts. And it's this really interesting mix of technical mechanics and some fundamental belief. It wasn't just one thing.
Let's break them down. Catalyst number one is a term that gets thrown around a lot, maybe incorrectly sometimes, the technical short squeeze.
Right. And in this case, the analysis suggests the setup was pretty much textbook.
Okay, so for anyone listening who just thinks of, the meme stock craze from a few years ago, what were the mechanics here for Knightscope?
You have two key ingredients. First, the report notes KSCP has a low float.
Meaning not a ton of shares are actually available to be traded.
Exactly. It's thin. So it doesn't take a huge amount of buying to really move the needle.
Okay.
Second, it had historically high short interest. A lot of traders were betting against the stock. They borrowed shares, sold them, and were hoping to buy them back way cheaper.
They were confident the price was going down.
Until it didn't. Remember that 380 wall we just talked about?
Yeah.
When the price blew past that, those short sellers were instantly losing money. And when shorts start losing money in a low-float stock, panic sets in fast.
Because their losses are theoretically infinite if it keeps going up.
Exactly. So they have to buy the stock back to close their position.
Yeah.
But here's the beautiful irony. By buying to get out, they're adding to the demand,
Which pushes the price up even more.
which forces the next short seller to cover. It's a feedback loop, a domino effect. And the report suggests this was a huge part of Friday's rally.
Forced buying. So it wasn't just organic interest.
A significant part of it was forced buying, yes.
Yeah.
The shorts were scrambling for a very small exit door.
Okay, so Catalyst 1 is the shorts getting squeezed. But the report also mentions something bigger, Catalyst 2, sector rotation. This feels more macro.
It is, and this is a really important piece of the puzzle for where we are in 2026. The report highlights a rotation out of mega-cap tech.
The giants, the trillion-dollar clubs that have been carrying the whole market.
Right. But investors are starting to feel like the easy money's been made there. A $2 trillion company isn't going to double overnight.
It's just math.
It's just math. So where does that capital go when it's looking for growth?
It flows downhill to riskier things.
It flows to risk. It flows to volatility. And according to this analysis, it's rotating into high beta AI and robotics microcaps.
High beta. Let's define that. That basically means hold on tight, right?
Glass. Essentially, yeah. It just means it moves more than the overall market. So if the market's up 1%, a high beta stock might be up 3 or 4. It implies action.
So people are hunting for multi-baggers. They want the next big thing in AI and robotics, but they want in on the ground floor.
That's the treasure hunt mentality.
Uh.
Where can my money double or triple? And Knightscope fits that profile perfectly. It's small, it's robotics, it's AI, it ticks all the boxes.
Which brings us to the third leg of this stool, Catalyst 3, the valuation gap. Because hype can only get you so far.
You would hope so. The report points out that Knightscope's market cap is only around $46.4 million.
That's tiny for a public robotics company.
It's definitely microcap. But the really interesting part, the part that the value hunters latch onto, is the business model, machine as a service.
I love that acronym.
It's a powerful concept. I mean, think about it like selling a toaster versus selling a streaming subscription.
Okay.
Sell a toaster, you get paid once, that's it. It's purely transactional.
You're always chasing the next sale.
Right. But Knightscope isn't just selling a robot. They're selling the security service the robot provides as a subscription. Recurring revenue.
The holy grail for investors. It's predictable. It's sticky.
Exactly. Wall Street pays a much higher multiple for that. And the report suggests that value investors saw the stock in the 350s and thought, that doesn't reflect the potential of that Moz model. They saw a gap, and they stepped in.
So you have this perfect storm.
Yeah.
Value hunters create a floor, sector rotators add momentum, and then the short squeeze lights the fuse.
It explains the why of Friday perfectly. It was everything aligning at once.
Okay, so that was Friday. But the report is titled, Don't Miss This Move, which implies the move isn't over.
That's the bullish thesis. But the market never owes you anything.
So let's talk about the forecast. The report lays out a scenario plan for this week. One-hit wonder, or is there an encore?
It's presented almost like a flowchart, 2 main paths. Scenario A, they call the blue sky breakout, and Scenario B, the back test and consolidation.
Okay, let's start with the fun one. Blue sky. What's the trigger?
The trigger is Monday morning, pre-market trading. The report says the stock has to hold above $4.
That big psychological number.
It's huge. If it holds $4, the analysis suggests we could see the FOMO crowd jump in.
Fear of missing out. The people who saw the 13% jump spend the weekend reading about it, and now they want a piece.
Exactly. That retail wave is the next layer of fuel. And if that happens, the report gives some specific targets. First stop, 450.
Why 450?
Just a standard psychological resistance level. $0.50 are often speed bumps. But if it clears that, the next major target mentioned is $5.25.
$5.25, wow, from $4.
Yeah.
That's another 30% move.
It'll be a huge move. The report calls $5.25 the next major liquidity zone.
Yeah.
Basically an area where a lot of sell orders are probably waiting.
So that's the dream scenario. But markets rarely go in a straight line.
They never do. Which is why Scenario B, the back test, is arguably more important to understand.
This sounds less exciting.
It's less exciting, but it's much healthier market behavior. The report actually calls this a neutral to potentially bullish setup.
So what happens? It dips.
It dips. Back to the scene of the crime.
Back to 380.
Exactly, the old ceiling. In technical analysis, an old ceiling often becomes the new floor, so the stock might dip to retest that 380 level to see if buyers defend it.
And if it drops to 380 and bounces, that's a good thing.
It's a great thing. The report calls this the buy the dip zone. Holding 380 confirms the breakout was real. It builds a solid foundation for the next move up.
But there's a danger zone here, isn't there, where the floor collapses?
Always. The report is crystal clear about the invalidation level. If KSCP closes below $3.55.
Which is below where Friday even started.
Right. If that happens, the breakout has failed, the thesis is broken, it means the Friday buyers vanished, and the downtrend is probably back on.
So 355 is the line in the sand.
That's your uh-oh moment.
Okay, so we have our scenarios. Blue sky to 525, a healthy dip to 380, or the danger zone at 355. How do we know which one is playing out? The report has critical watch points.
These are your dashboard indicators. And the first one, the most important one in these setups, is volume.
Volume is king.
The report states it very clearly. Monday's volume must match or exceed Friday's.
That's a high bar. Friday was a frenzy.
It is, but it's what you need to confirm a real breakout. The report warns about a fake out. If the price is drifting up on Monday, but the volume is tiny, be very, very careful.
Why? I mean, if the price is going up, isn't that good?
Not if there's no conviction behind it. A low-volume rally means there's just a lack of sellers, not a flood of new buyers. That kind of move is fragile. It can collapse in an instant.
So low volume on a rally, don't trust it.
Don't trust it. Treat it like a trap.
Now, there's another watch point here that it gave me a little pause, the after-hours warning.
Yes. This is the crucial detail. It kind of dampens that pure blue sky enthusiasm.
What happened?
In after-hours trading on Friday, after the market closed, KSCP actually dropped 2.73%.
It fell back to 392.
Right. So it slipped back below that key $4 level.
So it's already failing the hold $4 test before Monday even begins.
Technically. Now, after hours is thin, it can be volatile, but the report frames Monday morning's open as a battleground. The bulls have to immediately reclaim that $4 level.
And if they don't?
If they don't, we are likely heading straight for scenario B. That retest of 380, the momentum stalls.
So the first 15 minutes on Monday are going to be a real fight.
A huge fight.
Okay, the third watch point is news flow. The report mentions looking out for a PR.
Yeah, contract win, new deployment, something like that.
Is it common for the stock to run before the news comes out?
In the microcap world, it's almost standard procedure. The report notes this pattern. The stock rallies before the official news. It's that old saying.
Buy the rumor, sell the news.
Exactly. People start speculating that news is coming. So if a press release drops Monday saying Knightscope deploys 50 new robots, that might be the reason for Friday's move.
And what happens when the news actually hits?
Often the stock drops because the people who bought the rumor are cashing out on the people who are just reading the news.
So you have to be really careful. It's a game of 4D chess.
It's momentum trading. It's not passive investing.
So let's bring this all together. What is the analyst's main takeaway from this report? The big picture.
The analyst really emphasizes that while the move to 403 is significant for breaking the downtrend, the real move hasn't actually happened yet.
The real move, what does that mean?
They argue that the real trend reversal only happens if and when they clear $5.
Ah, so everything happening now is just the opening act.
In their view, yes. Breaking $5 would signal a longer-term macro trend reversal. Until then, it's still just the early stages of a recovery. The report calls this a high-risk, high-reward entry.
High risk, high reward. That feels like the perfect summary.
It is. The chart suggests the bottom might be in, but that after-hours weakness is a big flashing yellow light.
Not for the faint of heart.
Definitely not.
Okay, so let's recap the fork in the road for everyone listening. We're standing at Monday morning's open.
Path 1. We reclaim $4, volume is huge, and we make a run for $5.25. That's the blue sky.
Path 2. We slip, momentum fades, and we test 380. If it holds, we build a new base.
And path 3, the trapdoor. If we close below 355, the thesis is void, the party's over.
Simple as that, the numbers don't lie.
They don't, they just wait for us to interpret them.
Before we wrap, I want to leave you with one final thought. We talked about that machine as a service model earlier.
The valuation gap?
Yeah. Regardless of whether KSCP hits $5 or drops to $3.50 next week, that business model is really fascinating.
It's a total paradigm shift for a hardware company.
Right. In a world where hardware is becoming a commodity, shifting to a service-based recurring revenue model, that fundamentally changes the stability of a robotics company, doesn't it?
It absolutely does.
Yeah.
It moves the conversation from how many robots did you sell this quarter,
Mm.
which is always lumpy, to how much value are you generating every single month?
It's like a utility.
Exactly.
Yeah.
It turns a robotics company into something that looks a lot more like a software business.
Yeah.
That's the long-term play here, way beyond this week's stock chart.
Something to think about while you're watching the ticker on Monday. Are you trading the squeeze or are you investing in the business model?
Always the right question to ask yourself.
All right, that brings us to the end of this deep dive. Just a quick reminder, we are reporting on the analysis in this source document. We are not financial advisors, and we're not endorsing any stock.
Always do your own research. Manage your own risk.
Absolutely. Thanks for joining us.
Don't forget to like, share, and subscribe for more.